practice or are you running a business? Valuation is the ultimate KPI.
Hey there, it's Mike Langford. Welcome to another episode of the Modern Financial Advisor podcast, brought to you by Trulytics by Envestnet. This week on the show, I have Aaron Klein, CEO of Riskalyze, with me, and we dive into how financial advisors can grow their business in terms of winning new clients, increasing share of wallet, and reducing client attrition by getting better at helping clients understand risk and, as a result, gain more comfort with their financial journey. This is a transformative episode. You are absolutely going to love it. Okay, before we get to the conversation with Aaron, please make sure you subscribe to the podcast on Apple Podcasts, Spotify, Google, Amazon, the YouTube, so wherever you like to get your podcast jam on. And if you have a question or a suggestion for a guest or a topic for the show, hit us up. Simply swing by Trulytics.com and use that little contact button there, or shoot us an email, podcast@Trulytics.com. Okay, let's get to the conversation with Aaron Klein. Aaron Klein, so wonderful to see you this morning. And frankly, as I was telling you before we clicked record, so wonderful to see anybody, frankly, this morning. Welcome to the Modern Financial Advisor podcast.
Great to be with you.
Oh, yeah, it's great. So for those people like, what is Mike talking about? So I live in Austin, Texas, and we just came out of not having power for several days. There was a big ice storm that came and wiped out a whole bunch of trees, and all sorts of insanity and craziness ensued. One might say risk showed up.
Unexpected risk. It was a 5% probability event in your front yard.
Yeah.
Check it out.
So you're going to love this. So I am a nerd when it comes to risk. I actually do love this conversation. So we're going to be diving deep into, what you're doing there at Riskalyze and how advisors can leverage that. But, so one of my business school professors, his name was Zvi Bodhi, Dr. Zvi Bodhi. He's, he wrote the book called Investments that is used in basically every business school in America. And he studied with Merton and Scholes, who created the Black-Scholes model for options and so forth. So risk was a very big part of our class. And so, one of the things he always talked about is a lot of people think about risk in terms of price volatility, right?
Yep.
And planning for events. But one of the concepts that often gets overlooked is timing and severity of risk, right?
Yeah.
Having electric heat like I did when a ice storm hits, bad timing and kind of severe when if it lasts too long, right? So anyway, so I'm living risk right now.
We're going to try to have a very high energy podcast to offset the last 5 days of no energy for you.
I love it. We'll be like Monsters Inc. That's my son joked. He's like, what if it was like Monsters Inc. and you could just power your house with screen power like that?
That'd be perfect.
That would be great. Oh, anyway, I'm so thrilled to have you on the show. Not just because I can see you and I have electricity now, but just because I know you're going to be an amazing guest. I really enjoyed the conversation that you and I had with John Prendergast at RIA Summit this past fall. And since that conversation, I have been itching to have you on the show.
All right.
Because you're fun to talk to, but also you said something that's been nagging me.
Okay.
And I want to dive into it.
Okay.
You said in that show, and I'll link that up in the show notes so people can go check it out.
Sure.
You said something like that Riskalyze has something like an 87% market share for advisors who use a risk solution, which sounds absolutely amazing. Who wouldn't want an 87% market share?
Sure.
But then you said, however, when you factor in the percentage of advisors who actually use a risk solution, you only have a 9% market share.
Yeah.
So plenty of room for growth, which is also awesome. I guess you can look at it both ways.
Sure.
Well, I think it begged the question for me, and I've been dying to ask you this question.
Sure.
Why do you think so many advisors are rolling without a risk solution? Because risk is so important, as we were kind of teeing up at the beginning. Risk in your life, and particularly in your financial life, is such an important thing to have a firm grasp on, understand, and then make decisions based on how are you going to mitigate that risk or whatever. So what are your thoughts processes and why so few advisors are using one?
Yeah, I mean, it's a great question. I would say, first of all, I think that, I don't know, if you think about how we've dealt with the concept of risk as an industry for years and years, we've generally thought of it as a bit of an afterthought and a bit of a concept. It's I've always said there's two things that advisors have been told never to talk about with their clients, and it's not religion and politics. It's risk and the short term, right?
Yeah,
And the problem is that human beings react to risk in the short term, right?
sure.
So it has a profound impact on financial advisors, but periods like the last decade, where the markets are just going up, 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 can, I mean, I love the quote from Warren Buffett. It's when the tide goes out that we find out who's been swimming naked, right?
Yeah.
And so like it can kind of cover up a lot of the challenges that can exist when people start to react to risk in the short term if you haven't been talking about it and you haven't been illustrating it and you haven't been putting it into context. And I think that that's a core part of what Riskalyze really helps to do is, do a couple of key things. Number one, say, here is, let's look at your investment portfolio and let's define what is normal for this portfolio 95% of the time. And then let's define what 5% probability events could look like using things like stress tests.
Mhm.
Okay. But if I zoom up out of that and more directly answer your question, like why are there so many advisors rolling without a risk solution? I think that the really key variable is that most advisors don't realize how a risk solution drives growth and
Mm.
drives growth for their businesses via two things: client acquisition and retention. And I'll kind of unpack those this way. First of all, in the classical advisor that we think about, I've been in a couple of these meetings. I've been a fly on a wall, like watching a couple of these meetings. I feel like there was this thing, and in many places, by the way, there still is this thing where the advisor has to deliver a bit of an image, right? Like, I manage money for a living. If somebody at a cocktail party asks them what they do, they say, I manage money for a living. I'm a financial advisor. That's what
Yeah.
I do. Okay. So it's incredibly important that they have this image of success. And it's all built around trying to land that next client. Because if you walk into an advisor's office and you look around how they're, especially by the way, pre-COVID, okay, if you look around their office and the walk into their office, like everything is designed to have you say, this person is a winner. This person is very successful. They have obviously done very well with their money, and they're going to do very well with mine. And that starts with the gleaming Mercedes that is usually parked out front, okay, with like maybe Fin Advisor on the license plate, or something like
First
that,
of
right?
all, there will be no besmirching Mercedes on this podcast.
No, it's a great car.
And
Great
that's
car.
my F1 team. That's my F1 team. So there
There you go. There you go. Great car. It's a great car. But you walk past that and you walk up the stairs and you walk into the office. It's a very well appointed office. There's a lot of glass. There's a lot of there's a lot of gold. There's a lot of good colors and frames, warm colors, typically very inviting. You go into the advisor's office and you're just going to see like symbols of success everywhere, right? And you're going to see a credenza with gleaming photos of the advisor with their family. And if they don't have a family, they will hire somebody to be in the gleaming photos of their family as their family, okay? And what is all of this about? This is about an image. And pre-COVID, this is how you got clients. I look successful, okay?
Yeah.
All of that gets neutralized, by the way, in the post-COVID era. But even before COVID, what was interesting is we tried to say, listen, like it's not enough. There's been too much happening in the financial services industry for people to trust appearances. And we've got to strip a lot of that away and figure out how do we put data behind this. Now, I'm not saying that every advisor should trade in that beautiful Mercedes. What I am saying is that we've got to put data into the picture and we've got to have a conversation that is backed up by data. And you know what really builds credibility and trust? It's not gleaming photos and a nice car and a nice office. What really builds trust is when you show somebody something that they didn't understand before, that they instantly believe is true, and you can show them a path to success. What do I mean by that? When I have gone through the Riskalyze process with somebody, yes, of course, it documented what the client's risk tolerance is. Yes, that's helpful for like a compliance issue down the road, okay? But that's not the point. The point is for Mike to tell his financial advisor, I am a risk 44, Okay.
Mm.
And then for the advisor to be able to flip around and say, well, Mike, let me show you your current portfolio is invested like an 89. This might be why you felt like things were bouncing around too much. Okay.
Yeah.
And let me show you. And instantly, by the way, you go, I believe that is true. I get it
Yeah.
because I have always felt that. Okay. If you're telling me you're comfortable being a 44 based on a quantitative objective measurement of how you relate to a dollar amount that's relevant to you, then you are instantly going to relate to the fact that your portfolio is invested at a higher speed limit, at a higher level of risk, okay,
Right.
than you're comfortable with. It's driving too fast. And that just resonates with you. And then when the financial advisor can flip the coin and say, let me show you how I would typically invest somebody like a risk 44. It's my risk 50 portfolio, still a little faster than 44, but much more in line.
Yeah.
And let me show you what that looks like. Okay. That is a great conversation and it builds credibility and it builds
Yeah.
trust. And it does that far faster than just image, right?
Yeah.
It also lays the groundwork for your expectations because now you have good expectations for how the portfolio is going to perform over time. Not that it's always going to win. In fact, we're talking about the fact that it's going to have some losses and it's going to have some wins. And this is how it might behave in a 5% probability event, like say the 2022 inflation crash. Okay.
Right.
And so we're talking about those things. And so that's why risk ends up somewhat counterintuitively driving growth, both via new client
Yeah.
acquisition and via retention. And the issue is that way too many advisors think that a risk solution is an insurance policy against a client arbitration. And I think
Yeah.
many of them are great advisors and they consider themselves great advisors and they ask themselves the question, why buy insurance today for a crisis that might theoretically happen tomorrow? And the truth is
Yeah.
is that there are some business protection elements to implementing a risk solution, but the number one and number two reasons to actually implement one in your practice are retaining the clients you have and bringing new ones aboard, expanding access to your advice.
I love that you focus on retention uh,
Mhm.
strongly there because to me, it's in my opinion or my experience too. I think in being in this industry now for we won't say how many years, so it's close to 30 years. Let's go. So, anyways, being in this
I
industry for as
didn't
long as
know
I
that they
have,
let 12-year-olds work in this industry. That's pretty
this
cool.
is
That's something
why I
else.
like you having you on
Yes.
the inside. This is why I like you're always welcome back, Aaron.
Okay, thanks.
So the you know, I think a lot of people, and you hear it frequently from advisors and from firms. We grow by via referrals and so forth. We've had lots of our clients for this long, and
Right.
but like I used to work at Fidelity Investments, and so you have the advantage of having the law of large numbers right in front of you. You have a
Sure.
very large
And the
population of
brand
customers.
and all those
Yes,
things. Yeah,
yeah.
absolutely.
So you're able to look down at the 30,000 foot level and see clients of every, every decile, way up to ultra high net worth and the private office type of thing, family office type of experience, and down to
Yep.
normal average American experience. And what you get to look at is what is the average retention? What is the client retention, right? And you do look like, look, there is churn at every level. I don't care what your business is focused on. You are going to lose some customers, some
Yep.
clients. Why? Well, sometimes death, right? The client dies, his or her children are like, hey, I've got a financial advisor, just move my money over. So that type of thing
Right.
happens. Divorce. We know that it's something ridiculously high that if there's a divorce, the wife will move, or ex-wife now, will move her stuff someplace else. She doesn't want to be with your
Yep.
advisor. So like there's all these reasons why. But to your point, and one of the things I love that you zeroed in on this is that meeting expectations is so important, or helping somebody have realistic expectations for what
Right.
this experience is going to be like is a
Right.
driver of growth. And growth, by
Because
the way,
it
growth.
comes both ways, by the way. Firms lose clients when markets are screaming upward because they are asking the question, why is the market beating my portfolio? When
Right.
that wasn't the goal in the first place,
That's
right?
right. Yeah.
And then they leave when markets are going down because they're like, oh, like we're just losing so much money. We have to put things in context for people so they understand what to expect. And without the right expectations, how can we expect to retain them?
That's right. So, the easiest one is like, hey, listen, the market is down, let's call it 20%. Mr. or Mrs. Client, you're only down 8%. Why? Well, we talked about this, right? We built this
Right.
in. We realized that you were not going to be overly comfortable with down
Right.
markets. Now, one thing I do want to dive into here before we kind of jump into the next section of growth, because we're going to focus
Sure.
heavily on growth here, is how do you how does this at a high level, obviously you're not going to give away the secret sauce of how the Riskalyze solution works, but like how at a high level does an advisor using a risk tool like Riskalyze really go about like understanding the client's risk? Because one of the things we always talk about, like you don't really know
Mm,
what your risk tolerance is until you're in it, right? Like a lot
yeah,
of people are like, oh yeah, let's go. Like I'm all for growth and whatever. Like to your point, many clients, this is crazy, but like many professionals who are making really good money and starting to hit their peak earning years and putting money
yep,
away are experiencing some of their first real down markets like
for
their
sure.
whole adult prime careers, early 30s to 40s. They might have just been every time I open up my portfolio, it looks better. My
Yep,
statement looks better. So
yeah,
how do you go about
it's a great
assessing? Because
question.
it's an emotional thing, right? Like I know it when I feel it. This sucks. Yeah. Right.
Listen, there's no doubt that I think, lots of people would say, for example, I went through training in the military, and there's no amount of training in the military that can prepare you for bullets actually whizzing over your head, right?
Right.
And so we're very much in the same time. I mean, listen, I've seen that in my career working with investors in my business, okay? Because when you're working with investors in your business and it's their first financial crisis, okay, and I dealt
Mm,
with that in 2008, and I dealt with that more recently. They've just never experienced anything like it, so they don't quite know how to respond. And I think the same thing is true of the clients of financial advisors, and it can be different. But I will say this, okay? First of all, the typical risk tolerance questionnaire that exists out there, again, it has been designed to do one thing, and that is to paper the file to cover the advisor's rear end if the client were to come back and trigger some kind of arbitration or claim. Okay,
mm.
that is not a particularly useful document. I just don't think it's particularly useful. It may help you out a little bit in arbitration. I'll tell you what would be a lot more helpful in arbitration if we actually got the client to better understand things and documented that. Okay,
Yeah.
just writing on a piece of paper. Oh well, like how do I feel about investing? I feel very excited about investing. Okay, great. I'm glad that you had that they checked that box and that they signed that page. But that, if your portfolio was a car, what kind of car would it be? Tesla. Okay. Well, I'm glad that they wrote that down on the page, but like that's not actually going to deliver a better outcome to the client. So we've actually written a lot about the methodology here, and I'm going to like one small piece of the Riskalyze platform, but I will talk about the risk questionnaire here for a second because it's built on
Sure.
top of the academic framework that won the Nobel Prize for Economics in 2002. It's called prospect theory. And it's the idea that Kahneman wrote about this in Thinking Fast and Slow, New York Times best-selling book. It's the idea that we can best understand people's risk tolerance when we understand when they prefer risk and when they prefer certainty using real dollar amounts. Okay. Now, if there's a little bit of a flaw in Kahneman's work, it's that it was done with nominal dollar amounts, but see, he was doing it with college students. That's why it worked. And when
Yeah.
you ask college students to say, would you rather take $20 or would you flip a coin and heads you get $40 and tails you get zero? Okay, like that kind of risk reward trade-off is something that a college student who just wants to have some pizza later tonight like will decide whether to take the 20 or flip for the 44. Okay,
Yeah.
but point being is that we built on top of that and said, as interesting as Kahneman's work was, and it really boils down to what you would call monetary utility theory, which was a concept that everybody would use in academia but had never really been commercialized until Riskalyze. We said what you've got to do is you've got to build on top of that using real dollar amounts that are relevant to the individual. Because I can't relate to Warren Buffett's money. And I can
Right.
guarantee you that if he did the Riskalyze process with my dollar amount, he would be a risk 99 because he would be like, well, this is a trivial amount of money. Risk, risk,
Sure.
risk, risk, risk. Okay. But the point is that when I go through and do the Riskalyze process using real dollar amounts that are relevant to me, I end up with a pretty stable measurement that is as close as it gets to actually putting me with the economic bullets whizzing over my head, okay, and asking me to make a judgment call about whether I'd be willing to see that much money disappear out of my account in exchange for the amount of risk I might take here to have some upside. So, and here's the great thing. We actually got the proof that it works, okay? Because we took all the people that had done the questionnaire in 2021 and all the same people that did it in
Mm.
2022, because, hundreds and hundreds of thousands of clients. I think it was millions of data points that we were able to use to prove this. And we took all of that client data. And here's what's so interesting. We ask a market sentiment question in the risk questionnaire. Okay. We don't do that to affect the risk tolerance, the risk number. Okay. We do that just to capture the data, because risk tolerance is not market sentiment. We don't want risk tolerance bouncing up and down everywhere, right? But we wanted to test the difference between those things. So we asked people, how do you feel about the markets, positive or negative? And every time they clicked positive, it was a +1 in the numbers. Every time they clicked negative, it was -1. That number year over year plummeted 128% year over year. It makes total sense. We went into the 2022 inflation crash. Like, who's going to feel positively about the markets? Apparently, a few people were still clicking positive, but not nearly as many. So down 128% year over year. Guess what? The same people's risk number was stable ±2%. Okay. So what I think we demonstrated with that data, I mean, here we are a decade into doing this for financial advisors, is what we've been saying for a long time, which is we don't see people's risk numbers bouncing around a whole lot. It's a very stable measurement of how people feel about what they can handle in their portfolios and how they can be comfortable staying the course even through turbulence. It's incredibly important for a financial advisor to pair that up with the understanding of how much risk the client needs to take in order to reach their goals. And that's where the beauty of the financial advisor conversation comes, because people need help figuring out if there's a misalignment between those two things, whether they should be kind of psych themselves up to take more risk in order to achieve their goals, or maybe bring the goals down a little bit to allow them to feel comfortable with the amount of risk that they're taking. One or the other has to give so that we can get people into alignment with where they need to be.
I love it. I love it. It is so true. Like as we were talking about before, it's an expectations thing, right? So that's what
Right.
you basically just measure, like, is what's happening matching up with what we expected as Riskalyze the firm, but
Right.
also as the financial advisor who is advising these clients. Like, did we do a good job of setting these clients up for emotional stability, right? I always talk about, like, one of the reasons why a client hires an advisor is for a steady hand at the wheel, to take the reactionary emotion out of it. Because when I make the decision, hey, this is a great investment idea, isn't it? And when it starts going south, if for whatever reason, what am I going to do? Am I going to double
When we
down?
see
Am I going to
red, we're
crash
inclined to just go sell. Okay. And that's, like, of
Yeah.
course, the worst possible time. Our psychology tends to sabotage our investing.
Yeah.
So not only is it a steady hand at the wheel, like you just said, and all the behavioral coaching that goes into that, it's also, frankly, just having the confidence to know how to think about this, to be able. And again, I think it comes to that, even in peacetime when markets are going up, I still need help understanding if there's a mismatch between how much risk I need to take in order to reach these goals I've laid out versus how much risk I'm comfortable with. What
Right.
wins? How do I make a decision between those two things, or should I try to find something in the middle? And I
Yeah.
love the conversation I've heard advisors have in that regard. They're like, well, listen, you and your spouse seem very attached to these particular goals. Okay, we can ratchet up the amount of risk you're taking in order to take the amount of, you wanted to be a 44, you need to be a 62 in order to reach your goals. We can build you a portfolio that's a 62, but you've got to promise me, Mike, that when it hits the fan, and it assuredly
Yeah.
is going to hit the fan, like the market, that's what
Yeah.
the markets do. So when it does, you have to promise me that you're not going to sell at the bottom of a 5% probability event, because that's just going to make you even further away from your goals than you might be today. Right? Great
I love that.
conversation for the advisor to have.
That's fantastic advice for the advisor, right? Because
Yeah.
one of the things that I've done this exercise in the past, and it's always worth doing and revisiting every time we have a market dip, to see how long
Yeah.
does it take to get back up to flat, right? To the high water mark.
Right.
How, like, right? So, okay, we're down 20%. I don't know, but my historical look is like, within 3 years, even after
Yes.
massive crashes, we're usually back up to our previous high water mark. We're back to level, right?
Big
And
exception
so,
to that. Big exception to that, Mike. Unless you sell. I still know people who have never gotten there because they sold in 2009. They finally capitulated in like February of 2009. And guess what? The market started retracing in March. Okay. And they've never gotten back to where they were. You're 100%
I had to have
right.
a conversation with somebody at that exact time. To your point, the market was tanking, and he decided to pull all his money and go to cash. I'm like, so when's the good time to come in? Like, when are you going to get back in?
How
You get
will
back
you
in when it's
know?
back up 5%? You got to wait till the market's back up to like where it was before. You just took this
Yep.
huge loss, monstrous loss.
Yep.
Congratulations on your tax loss harvesting, but your goals were saying you wanted to keep growing. Like right now, it's a paper loss,
Tax
right? Like
loss harvesting is nice, but it doesn't pay for retirement very well.
it's fantastic. I have a weird question that we can edit out if you don't feel comfortable answering it, or if it's
That's
like
all
a
good.
question that you think is stupid. And I'm okay with you telling me you think my
Fire away.
question is stupid. One of the things that has been popping up that's been of interest to me, and I've had folks on the show who are creating technologies that allow advisors to now manage portfolios of individual securities versus having funds and in ETFs, whether they're index funds or
Like
other.
direct indexing and stuff like that.
Yeah, basically like direct indexing for an advisor, like, but super easy. Like you could come in as an example. I'll name the name because they like the promotion. It's a company called Vise, right? They've got a solution that's AI powered with machine learning. They're able to look at a client's preferences on a whole bunch of levels. Like it may be a scenario where, hey, I want diversity of people in management and on the boards of the companies that like this is really important for me. So I don't want to have invest in companies that don't have board members that are women or of other diversity metrics for me. I can't have my money invested in Facebook because I work at Facebook. On and on the list, all these different preferences. So what I suspect is going to happen. I don't know if it's going to be huge, but you're going to have many advisors now who are putting their clients in portfolios of individual securities versus index funds, right? So the scenario that you and I were just talking about, like, hey, in the S&P 500, I know if it's down X, that within X amount of years, it's probably going to be back to where it was before. So we're going to have to ride out some of these.
Right.
Now, we're assuming that whoever builds a portfolio of individual securities did a good job of balancing, of diversifying the portfolio.
Right.
But when you bring a risk tool, do you treat those types of portfolios different? Because I would make this is my judgment personally. I see the risk associated with an indexed portfolio dramatically different than one filled with individual securities, right? Because I don't know if the company that just got its pants taken off during a down thing might just be on the way down to nothing now.
Great
Right.
question. Great
So
question.
do
And so
you think about
listen,
that?
I think it's a great question. We do look at it differently. And here's the beauty of what we decided to do when we built our risk modeling. When we built our risk modeling for portfolios, we made this fateful decision that turned out to be in hindsight, a great decision, which was we are going to go to the securities level at all times. And that means that for the index fund, we are looking at the performance of the index fund. And of course, if you own, I'll just let's make life simple and say an S&P 500 fund. Okay.
Yeah.
You are owning the performance of the 500 securities less the fee, which is usually not that crazy. Okay. But that's the performance that you're owning. And that's the data that we're using to inform the algorithm. Okay. Yeah. Of what you own, and therefore how we should calculate the risk for that. And typically, let's just talk about a portfolio that might have 7 or 8 index funds in it. Okay, that could be an incredibly well constructed portfolio that's very efficient. And we're going to be looking at those 7 or 8 ETFs, and we're going to be or mutual funds or whatever they are, and we're going to be looking at the performance over time, both the volatility, the return, and we're also going to be analyzing the cross correlation between them so that we can actually measure and take into account the diversification that you're getting from that. And that's going to dial down the risk number as well. So we're going to be looking at those at that index fund level, because that, after all, is what you own. Okay. You own that indexed fund, and certainly its return and volatility and correlation is going to be driven by the 500 stocks that are owned by the fund, but you own the fund. So we're going to look at the data for
Right.
the fund. Okay. Now flip it over. If you take the account you're just talking about, and let's say that they've got like 80 individual stocks in it. Okay. By definition, that very well might not be. I mean, it might be, it might not be, but it might not be as diversified as the S&P 500 fund. I mean, is 80 stocks more or less diversified than 500? There is a law of diminishing returns, so I'm not going to answer that. It depends which 80 stocks and how well,
Right, of
as you
course.
pointed out, how well they constructed it. Okay, but we're going to look at the 80 securities there, just like we looked at the 8 funds. We're going to look at the track record of those securities and how they, how they correlate against each other and what their return and volatility has been. So, in effect, if you could perfectly replicate the S&P 500 index in an account and perfectly charge the same expense ratio that the S&P 500 fund, you should have a perfectly identical risk number and risk-wise between owning the 500 stocks and owning the S&P 500 fund. Okay. The reality is the proof is in the pudding, like you just said, on how they're managing that portfolio. And so that portfolio, that account with 80 stocks in it, is going to behave differently and have a different risk number than your S&P 500 fund. It could be higher, it could be lower. It really depends on how well they've done constructing the portfolio. And so that has served us quite well. A lot of the risk models out there say, well, we just, kind of like classify securities, and these securities classified into large cap equities. And so that the risk of those two things looks the same. That is not necessarily true. And that's the benefit of the risk model that we've built that goes down to the securities level and treats each security as an individual.
I love it. I love it. So I'm glad I asked this question now. It wasn't a dumb question
Great
at all. This is
question.
good.
Great.
All right. Let's shift gears into growth, because we've talked about
Yes.
a few times. It's come up. And you've talked about how having a risk solution can help grow new client acquisition
Sure.
and also can grow share of wallet and / retention of
Yep.
clients. I love this. I love this. One of the things that came up in the prep call
Yeah.
was the fact that advisors aren't growing their businesses aggressively, many of them.
Sure.
And I think the number that was floated out during our prep call was about 2 to 3% per year is what you're
Yep.
seeing from a growth
Yep.
perspective, which in our current environment is significantly lower than in inflation, right? So that means your business is actually shrinking.
Shrinking
And
to some
this,
extent. Yeah, that's right.
yeah, from a value perspective, right? Your business is your revenue at least is going to likely decline relative
Yeah.
in terms of real dollar terms. But this isn't the first time that this lack of growth concept has come up on this show. And it's one that I want to dig into a little deeper with you, because you and your team are focused on helping wealth management firms grow. You actually, if you go to the riskalyze.com, soon to be something else. We'll talk about that in a minute.
Yep.
You refer to your solution as a growth platform.
Correct.
I love that. I love it. So how can advisors boost their growth during a period of volatility like this? Like, so we're already talking about, okay, so your data was pretty spot on in terms of like meeting
Yep.
expectations, but like, it's one thing to meet expectations and have your existing clients happy. How do we
Right.
now go about growing and getting advisors to understand we need to be a little more aggressive in our growth?
Yeah, it's a great question. And the metric that probably the most interesting recent metric that I saw was the DeVoe and Company study, which said that, like, if you take out the impact of markets on the average wealth management firm, they're only growing 3% a year, which, again, like you said, lower than inflation. Firm is actually somewhat shrinking. And that's not great. Like, what we actually need to be doing is getting the impact of advice to more people, not to less, right?
Yeah.
So our passion is to figure out how do we help leverage technology to help our industry grow at like 5 times the average pace. I don't want to just double the rate at which these firms are growing. Like, I want to 5x the rate these firms are growing on average, because we need to get the impact of advice to more people. And that's something I'm really passionate about. So I think of it this way. Like, first of all, if you want to think about organic growth, it's, honestly, advice businesses are not that complicated. It's really simple multiplication, right? You have the assets you're managing on one side, you have your fee on the other side.
Yeah.
Most advisors would say this is a bad time to raise fees. Okay.
Sure.
Like probably after the market has gone into a tailspin and people's assets are down by some percentage, this is probably not the best time to say, oh, by the way, I'm going to increase the multiplier. And so I don't find a lot of advisors super excited about right now as the time to raise fees. So when I think about that, you really have a simple set of things that you can do. You can put more people into the top of your funnel. You can increase the conversion rate of how many of those people you turn into clients, and you can stop people from leaking out of the bottom of the bucket with churn, right? And so I think of the ways that we're really helping advisors drive that are, I think of 4 key ways. Like, one is we've got to help financial advisors to engage prospects at the front end and turn them into meetings more effectively. So many financial advisors are like great practitioners and bad business growers, right?
Yeah.
And so the passion is like, how can we take the growth platform and help those firms drive that growth? And listen, the marketing tools that are out there are incredibly important. You've got to have a good website, table stakes. You've got to have good social media, table stakes. You've got to have a way to like automate how you nurture those leads through your funnel, and kind, you've got to have campaigns and content. You've got to have ways to help, to drip on customers with email and all those kinds of things. But where I see Riskalyze starting to come into play, our growth platform, is engaging those prospects as they're nurturing through your funnel and helping to turn them into meetings, then helping you run those meetings really effectively and convert those people into clients at a much higher rate. And then keep those clients engaged and satisfied and retained because they know who they are, where they're going, where they want to be, and they're in alignment with that.
Yeah.
And then finally, being able to kind of step back and get the analytics and the insights. You've got this firm growing. Now you got to keep it on track and to have the analytics and insights to kind of do that. Things like compliance analytics to be able to see across your firm as you're adding advisors in your firm. Like, are all of those advisors doing a great job of documenting what they're going to do for a client, then actually doing that in the accounts?
Yeah.
And that's where a lot of risk starts to come in for a lot of firms. So that's kind of how we see helping wealth management firms grow. Accelerating conversion, accelerating engagement, accelerating retention, and then helping them keep the ship on track.
Yeah, I love all that. And I love that particularly now, right? Like when you've just experienced some, not once in a lifetime, but you hopefully once in a lifetime market conditions, right?
Pretty
That
unique.
that were
Pretty unique.
Yeah,
That's
unique.
right.
And we've had anybody who's in their middle earning years have experienced a couple, right? You had the 08, 09 crisis, and now you have coming out of a pandemic that hopefully we never see again, and
Right.
the economic shocks that happened there. It's a wonderful time to have a deeper level conversation with your
Yeah.
client. So as you mentioned, from a retention perspective, awesome. And from
Yeah.
a client acquisition, having that type of conversation that might not be happening at other places, also really smart. And I would also say from a increasing share of wallet, right? Like, hey, listen,
For
let's
sure.
talk about this. Most clients have some assets held away.
For
We think
sure.
we're doing a better job, right?
Yeah.
Here in terms of like making
Yeah.
sure you understand that your money's being put to work the way that, and we're
100%.
going towards your goals. Love it.
100%.
Okay.
That's great.
We're heading for home. We're close to the end of this recording, and I'm
Yeah.
gonna dive into like one of the fun topics I think people have started to hear on the street.
Okay.
So I'd be remiss if I didn't ask you about the rebranding process that you have underway at Riskalyze. When we last
Sure.
spoke up in Boston at the RIA Summit, you mentioned that the driving force behind the rebranding was that you already deliver much more value than just a risk questionnaire solution.
Yeah.
So that part of the business, as you said in the previous podcast, it's not going away, which is awesome. So
Yeah.
all the stuff we've
Yeah.
talked about before, still really
Yeah.
valuable. It's going to happen. But I wonder if you could take us through some of the process over the years of Riskalyze, and like, where do you see the future? Like, what are some of the value that you're bringing in addition to risk
Yeah.
questionnaires, and what can we expect? And do you have a
I
new
think
name yet? Can you tell us the name?
I don't. Our board has not made a decision on that yet, but I can tell you we hired a branding firm that is just absolutely storied in the business world in coming up with great brand names. So we're excited about some of the candidates that are being batted about and some of the places we might go, and we're hoping to announce that by mid-year.
Okay,
But
I'll
we
have you
hired
back
this
on the
great,
show.
yeah, there you go. We hired this great branding firm, and they literally came up with names like Sonos for the speakers, like
Yeah.
Febreze, Swiffer, the PowerBook for Apple,
Wow.
Pentium for Intel. So like it's a storied firm, and we're really excited to be working with them for this. And honestly, here's what drove us to this decision. You talked about we were a risk tolerance questionnaire in the earliest stages, and we've grown a lot since then. And we've talked a lot about that here already
Yeah.
with kind of how we're helping firms grow. And if I think about that, like I don't want to like just deliver a laundry list of like features and capabilities, but I'll just say, when you start with a risk tolerance questionnaire and you name the company Riskalyze,
Yeah.
it's the equivalent. I would argue we had a very broad vision, and it'd be equivalent of Jeff Bezos having named Amazon like onlinebookstore.com. Like would we watch movies put out by onlinebookstore.com, instead of
Right.
Amazon Studios? And would we buy all the things we buy from Amazon if it was called onlinebookstore.com? So Riskalyze has been a great brand name for us for a long time, but we just kind of realized here's the real key. Like people, this doesn't presage some massive change in our product portfolio, as much as we have been building for the last decade this growth platform, and that is where our innovation is continuing to be focused over our next decade. Okay. So if you're excited about the concept of, yes, risk centric, because we think that that's such a powerful client engagement tool, but being focused on how to drive all those things we talked about, engage with clients in the funnel, increase conversion rates, stop people from leaking out of the bucket, expand share of wallet, and keep that rocket ship of growth on track. If that's exciting to you, here's the thing that we discovered. Every one of the advisors that we serve, and we serve tens of thousands today, they know what they have. They bought a growth platform. Okay.
Yeah.
But guess what? Not a single one of them walked through our door looking for it. They walked through our door looking for a risk tolerance documentation solution that would help them paper the files a little bit more effectively. Okay.
Yeah.
And then we told them the story of a growth platform, and they got very excited about that, and they came aboard. And that's why, frankly, the vast majority of the advisors we talk with join us the first time we get the opportunity to like get in front of them. But from our perspective, when I think about like our company being 2 or 3 times as big as it is today, okay, and maximizing our impact on the profession, we need the next tens of thousands of advisors walking through our door and firms walking through our door coming to us because they're looking for a growth platform, not
Mm.
they're looking for a better way to document risk tolerance, and then they stumble upon a growth platform. And that's really the story of why we're doing the rebrand and going to all of that time and effort and expense, is because we've got to just tell our story in a broader way of who we turned out to be a
Yeah.
decade into our history, rather than who we were in the first year of our history.
I absolutely love it. I love it. I'm so excited to hear the name, but also just to see what's in the future, because I'm,
Can't
I'm
wait to
really a
share it.
big fan of
Yeah.
everything you're working on
Got to
there.
get my board to make a decision on it though soon.
Yeah.
So we'll
Get
we'll
off.
be we'll be we'll be doing that.
Let's move it. We'll have you back on the show. Okay.
There you go.
Last thing before I let you go, because this is kind of a fun little ending question here.
Sure.
The industry is evolving, and it's been evolving at I think, a more rapid pace, right? Because technology, fintech is pushing things quicker and quicker.
Yeah.
We've seen robo advisors, new business models like subscriptions coming on.
Okay.
Advisors are breaking away and to form their own RIAs, and now we're also starting to see roll ups and so forth.
Yeah.
What's the most interesting thing happening now that's kind of maybe bubbling up on the surface, or it's a trend you've seen for a few years? Like, what's the most interesting thing to you as you observe the industry? Because you serve the industry, but you're also removed, right? Like you're able to look
Yeah.
at it from the outside. What's most interesting to you?
I think what's most interesting to me is just how consolidation is like the circle of life. Like there's lots
Okay.
of firms being acquired, but there's also lots of firms getting started. And you read about
Hmm.
new firms getting started every day, and there's a bunch that we don't read about. and
Hmm.
and and so I don't know if it's a 1-to-1 or a 2-to-1 or whatever the ratio is, but there's just no lack of creativity and excitement about solving this set of problems for investors. And look, there's always going to be advisors who want the structure and support of being a part of a larger firm, and that's what drives consolidation. And there's always going to be advisors who want independence, and they want to be
Yeah.
able to pursue their own vision, and that's going to drive starting new firms. And so what I think is really interesting that we really need to do is yes, we can kind of look at a broad level and see that overall assets under management in wealth, like assets under wealth management, are growing. I'm really convinced that we need a better way to measure whether we're getting the impact of advice to more people. And this is why I get so passionate about that organic growth. Like, take the impact of the market away. How is the average wealth management firm growing? I get excited about that metric because it's not one that a lot of firms are measuring and paying attention to. I was asked to kind of sit in for the last couple hours of a strategy retreat for a mid-market, larger RIA firm and kind of speak to their leadership team. And, they have all of this analysis and these spreadsheets and these numbers up on how their firm is growing across all their different offices across the country. And that's a metric that they were not tracking. They're tracking a lot of metrics, but
interesting.
If you strip away market impact and ask yourself, how are we growing? That talks about the impact that we're having, either, like you said, share of wallet with expanding our impact on an individual person or expanding our impact to more people. And we need to get better about that as an industry. So, to me, that's what's really most interesting about where we go as an industry over the next 5 years.
I love it. And that's a wonderful perspective that you bring as a software company, right? That you bring that service into, like, that's how you think about your business. How many users, how many people actually using this platform? And then of the people who are using the platform, how many clients have they served with this platform? That's a different way of thinking about the business. Well, I know we got to go. We're up against it here. Really appreciate you coming on. People are going to want to follow up. So for now, they can go to riskalyze.com. We'll link that up. You're also very active on social, so you're easy to find on LinkedIn. Any other places you want people to kind of check you out, follow along?
Twitter and LinkedIn are probably my two most common. So and I'll go for long stretches of time. By long, I just mean like a couple of days at a time with absolutely nothing, and then I'll just be tweeting, I don't know, 5 or 6 times in a day, and people go, "What's the difference?" And I go, typically it's whether I'm traveling, because if I'm traveling, I'm standing in lines, and when I'm standing in lines or when I get time to play with social media. So there you go.
There you go. Fantastic. Well, Aaron, really appreciate you coming on the show. Thank you, sir.
Thanks, Mike. Thanks for having me.
Thank you very much for listening to and/or watching this episode of the Modern Financial Advisor podcast. It's always fantastic to have you with us. Huge thanks to Aaron Klein from Riskalyze for coming on the show as well. I have to say, I'm with him in his conviction that a risk tolerance questionnaire is not just a check the box item, right? Done right, it opens up a lot of doors for your business and for your clients' lives. All right. As I mentioned at the top of the show, please make sure you subscribe to the podcast on your preferred podcast platform. And if you haven't done so already, give the episode a share on LinkedIn and YouTube and all the other social places. Chances are, if you found this interesting, so will other members of your network, all right? So spread the love, baby. We love to have you as part of our community. All right, that's it for today. As always, be nice to each other. We'll see you next time on the Modern Financial Advisor podcast. See ya. Bye.